Welcome to Market Monday from the investment team in the trust department at the First National Bank. Over the next couple of weeks, we're going to get some pretty key data points that will inform us as to, the overall business climate and the economy, whether we're tilting toward recession or managing to continue to power on and continue with growth, despite the Fed having completed its rate hiking cycle and the pause period in between and started to tilt down in lowering rates at the last meeting. The data has been coming in quite mixed, although leaning toward the side that shows the economy is still in a relatively strong footing. And that means that the Fed may not be in a position to cut rates as drastically as interest rate markets were implying a few weeks ago. And they've subsequently come down a little bit in their expectations. When I say come down, I don't mean in terms of rates, but in terms of the positioning bets, if you will, for drastic rate cuts in the immediate future. So it remains to be seen what actions the Fed are going to take. But the data seems to suggest that they may have achieved their soft landing that they had been trying to get, which means, completing their rate hiking cycle and then moving to a neutral stance, relatively neutral by historical standards, and not tipping the economy into a recession, although we're not out of the woods yet. So looking at the stuff that's coming over the next couple of weeks, information about the manufacturing sector, the real estate market, business, and consumer sentiment outlooks, labor market again. We have durable goods orders, which is expected to show a decline. An upside surprise here suggests that the economy is stronger than previously expected, and we have seen some upside surprises here recently. The University of Michigan Sentiment Index. This is important because it shows how consumers feel about the overall economy, and it looks like analysts collectively believe that this is improving. And when consumer outlook is improving, consumers are more likely to spend, and consumer spending is 2/3 or more of gross domestic product growth. So this is going to be a relatively key number that comes out here on the 25th. We'll get information about wholesale inventories, and this is really key. Retail and wholesale inventories, Bloomberg doesn't assign a tremendous importance to it. You can tell by the little chart over here off to the side how important the system thinks it is. But in the context of an economy that may or may not be headed toward a recession, this information is going to be key. If there is a backup in inventory or a buildup in inventory, if you will, in any point in the supply chain, that suggests that demand is weakening further downstream and could be auguring a period of shrinking profits and shrinking sales, and then therefore shrinking economic growth over the medium term or short term. So we're watching that pretty carefully. Right now there are no real any kind of expectations in. This is a little bit further out, but we will be watching that pretty carefully. We get the GDP quarter-on-quarter change for the third quarter, which is expected to show a flat line from the prior reading, 3%. And that's still robust growth. That's more than the typical 2% that a developed economy can grow at sustainably over the long term. So this suggests, if the number comes out as expected, that the economy is actually relatively robust by historical standards. We'll get information about the core PCE price index, which is what the Fed looks at to determine what their reading of inflation is. It's notable that the last reading was 2.8, and an upside surprise here could indicate that inflation's reigniting after they cut rates. So we'll be watching that pretty carefully. We get information about the income and spending, and again, consumer information, more sentiment information, and then beginning of November, at the end of this 2-week period, we'll get the non-farm Friday, where there isn't a tremendous amount of jobs by historical standards that the analysts collectively expect is going to happen there. They're expecting 135,000 when the last reading was 254,000. Now, this number has been coming in much stronger consistently in the recent past than what analysts have expected. And that suggests that the labor market has been relatively strong. This will be another key number to watch to determine what's actually happening. Is it in line with expectations? And more importantly, is the labor market consistent or showing signs that are consistent with the Fed's need to continue lowering rates? We think that that's up in the air at this point. We'll get more demand information toward the end of the period as well after that. So going into the market has been just doing nothing but wanting to trickle up and up and up, despite news events like wars, There's issues that potentially can impact the price of energy. There's issues with some of the reports coming in on the bad side, and there's higher than what is comfortable interest rates for corporate borrowing when you consider the debt wall, debt that's coming due over the next couple of years that has to be refinanced at higher rates when companies originally financed it at near zero interest rates. So there is some potential weakness on the horizon, but the market has done nothing but go up, and that's a characteristic of bull markets. When the market goes up when there's good news, and the market goes up when there's quote-unquote bad news, generally we're in the midst of a bull market, and this chart is pretty suggestive that since October of 2023 the market has been in a bullish expansion. Going into the volatility index, that spiked recently at the start of the month, going down and trickling back into a range below 20, which would indicate typical volatility expectations. Although that's relatively higher over long-term standards, it's relatively higher than what the average would be. It's still at a level that does not indicate any significant stress in equities, and we're in the middle of earnings season, which has been by and large fairly good. Companies have been doing well and reporting good results. So it remains to be seen what happens, but as far as what the market is telling us right now, it's probably going to continue doing what it's doing unless there's some perturbation of the system from outside. Looking at treasuries, the yield has come down on the shorter term rather dramatically from the beginning of the year after the Fed lowered the short-term rate, and these rates on the short end of the curve are anchored there. But notably, it's come up over the past month as we start to go out further in the curve. This compensates for inflation expectations over time periods. That's really the main component when you price treasury yields as an investor. What is my expectation of inflation over the horizon that I intend to hold the bond, and I need to at least break even on my holding with respect to my purchasing power. So you can read this as a proxy that a large portion of this yield as the curve has gone up is relative to inflation expectations by large investors. That suggests that as we're looking at what the Fed's looking at, and what does the Fed think about inflation, we have to take into account that market participants see an extended period where inflation will be higher than it's been in the recent past or even medium-term past, and that is going to probably persist for the foreseeable future according to where the yield curve is reading right now. When we go into corporate bonds, the same sort of impact has happened, and this is a pretty sharply upward sloping curve, indicates relative health, and rates are decent. They're not what they were a couple of months ago where they were a bit higher, but they are still above for near 5% across the curve, and we need to look at that as being a positive for fixed income investors. It's likely to persist for some time if the inflation expectations that are embedded in the Treasury curve are taken into account. We are seeing rates remaining higher for longer, and the market seems to be adjusting to this new reality that's of a longer term nature. Coming back to the S&P, it continues to climb. We expect that to really continue unless there's some shock to the system. But again, we don't want to get too excited when markets are trading at new highs. We don't want to get too scared when they start coming down. It really doesn't mean much when you have short-term events. We want to be cognizant of the fact that we have long-term investment plans, and that over time, despite whatever exogenous shocks come in and impact the market, over time the market has been trending up and is likely to continue doing that, and we're going to want to adhere to a long-term, well-thought-out investment plan instead of reacting in a knee-jerk fashion to any of the news that comes out. So if you have questions about your portfolio or want to talk about any of this, the economy, stocks, what's happening in a certain sector, or what's happening in the market overall, interest rates, etc., feel free to give us a call. We love to chat with you about this stuff, and hope you found this video useful. Thanks, and have a great day.